Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're active, passive, you're working in the industry, or just a little bit curious, well, you are in the exact spot you are supposed to be, because every single week on the Gray Report, we are diving deep into the research, articles, and new data that comes out revolving the multifamily industry, real estate, and the economy. We've got a really special guest today. It's not just Matt and I kind of digging into these reports. We're kind of going straight to the source. We've got RealPage's Carl Whitaker here to talk about, not only what we're seeing in the multifamily market, but how RealPage looks at this data, how they do this analysis, and just learning more a little bit about Carl. And again, looking forward to seeing what the market in 2023 and beyond is going to look like. So without further ado, let's get into it. All right, welcome back to the Gray Report. We have Carl Whitaker with us. Carl, how are you doing today? It's great to have you on the Gray Report.
Yeah, likewise, doing good. Thanks for asking, and thanks for having us. Hope y'all's 2023 is off to a good start. But things are good. It's good to be able to join y'all. I've seen and followed y'all for a while now through your newsletter and on LinkedIn. So it's always good to cross paths with industry colleagues that are doing some similar stuff in some regards.
Yeah, absolutely. It's a small world. Real estate's everywhere. Everywhere you go in the world, there's real estate. But it's also not only an international market, it's an international market. It's so local as well. But in the multifamily space, and then the multifamily, housing and analysis and research space, it's a relatively small club. And so you're a member of that elite club that we follow all the time as well, and you and your colleague Jay Parsons over at RealPage. So this is a real treat. So just kind of before we get into some of the questions, Carl, can you just give us a little bit of background, personally, on kind of where you came from, how you got this position at RealPage, putting out this great content, and then a little bit about RealPage and what you all do.
Yeah, for sure. I'll start with RealPage, and then I'll dive into a little bit of background about myself. So, RealPage is a software as a service company, really touches on all facets of multifamily, whether investment or property management, lots of different products that support the needs of multifamily owners, operators, investors, et cetera. Specifically, the part of the company that I work in is our data and analytics division, which, as you would expect, is a natural marriage for the type of work that our team is doing, which is a lot of economic commentary. How is the economic backdrop influence in multifamily demand today? What is rent growth, occupancy? What does new construction look like, et cetera, et cetera? So that's what a lot of our team does, is involved in those types of conversations. And keep me honest from going on too long here, but just for a little bit of background about
Yeah.
myself, came into real estate kind of by proxy of my graduate degree, which is in geography. And a lot of people think geography, you're memorizing maps and tell me what the capital of Nepal is off the top of your head. But it's a lot more than that. It's a lot about understanding local dynamics in a place and what separates that place, the idiosyncrasies of it, which pretty naturally lends itself to real estate research. And immediately out of finishing up my degree, I got a job at a boutique economic consulting firm here in Dallas and worked there for a little bit. We happened to be subscribers at the time to RealPage, and then just kind of worked my way through the division and through different ranks, and now oversee our team of economists and analysts with my colleague and my direct boss, who is Jay Parsons, who you've probably come across as well on LinkedIn and Twitter and et cetera.
Yeah, you guys put out some great commentary, not just on the actual reports that you all are putting out, but also some consistent translating those to a little bit more kind of bite size on your LinkedIn posts. And I know both you and Jay, you guys get a lot of traffic and a lot of comments, and I think are really kind of fueling some really good conversations about housing studies in the multifamily market. Because I feel, and I've got a couple questions just on your background, because I think it's really interesting. But I feel like everyone that's a real estate investor has needed to become a little bit of an economist as well as a really kind of a specifically kind of having a background in housing studies and trying to forecast trends, because in the last decade, or really since the great financial crisis, it's been relatively linear growth, especially the last kind of 5 or 6 years, relatively stable. The fundamentals were pretty solid. It was not incredibly volatile. But then the pandemic happened, and the book went out the window. We had to kind of figure it all out from a complete macro sense of the economy shutting off. What does that mean for housing? And then the dislocations of lower interest rate, an incredible amount of of demand for housing of all kinds, to then this last year in 2020 when we just had the e-brake pulled on the economy. So we're all trying to kind of figure this out, and you guys are really leading this conversation. So I'm curious. So you're getting a postgraduate degree in geography studies. Did you think at that point real estate was kind of the natural place to go, or I guess when did kind of real estate kind of enter into your mind, and when was that part of the plan and direction?
Yeah, that's a great question. I think my path into real estate, or specifically apartments, was a lot like a lot of other folks, where you don't necessarily plan on heading there, but a natural path kind of opens, and you realize, hey, this is a really important part of the economy at large. And I talked to a developer, or I'm sorry, not a developer, operator, a couple months ago, and they brought up a great point. They said that they think one of the biggest challenges in the industry right now is educating folks that are in their early 20s, coming out of college, whatever the case may be, that apartments touches a huge part of the population, and none of us really plan on that path upon
Yeah,
graduation, or if we decide not to go to college. You don't realize that there's actually a very viable career to be made in apartments, and it serves a very specific, very important niche and need within the population, and that is providing housing, and
yeah,
providing housing that isn't single family. So I thought that was fascinating. But I guess more directly to your question, my initial goal was to go to grad school, get a PhD. Grad school took the wind out of those sails pretty quick, so that's been put on the back burner, to say the least. If ever, I'm going to revisit
yeah,
that. But I think some of it too, just being here in the North Texas area, just so much growth. There's so many companies here that offer
yeah.
really promising career paths, that I think it just kind of naturally unfolded that way. And things have just kind of worked out for the better by following that path, even if not by direct design.
It's an interesting point. Yeah, there really isn't a direct kind of path into the multifamily industry. I mean, I guess you could go, general business studies. There are some colleges that I know that have kind of property management degrees or paths, which is a niche within multifamily. That's kind of one path that you could take, but there's really no direct path. There's no multifamily real estate undergrad degrees. That's for sure. And then but it is such a big part of our economy. I mean, real estate as a whole. I mean, when we're looking at just the weight of housing in CPI, I mean, it's basically a third that takes up CPI. And to think that we don't really have this direct pipeline of talent, it's kind of picking apart from different paths. I mean, I did not. I was a music background, music major
Oh, interesting.
for my undergrad, and so I made it to private equity, real estate, and being an entrepreneur in a very indirect path as well. And then I find similar stories of people that are maybe doing something somewhat related, and then they kind of, I don't know, light bulb went off at some moment. Whether it's you're looking around, you're seeing these apartment buildings, and you're like, who owns that, and how does that all work? Or then in Dallas, which has such an exciting story right now in the past several years of just incredible, explosive job growth and all the development that goes along with that, and you can just see the path of development and path of progress, just as Dallas keeps getting built out, really in all directions, but especially going north. It's pretty exciting to see. So I want to just hit you with a question, and this is going to be a little bit kind of broad, and then we can kind of dig into it, but it's a little bit the elephant in the room. And so, we're seeing reports of just anemic traffic. I mean, apartment demand for the last, especially this last quarter, but really kind of the second half of 22 being kind of the worst since going back to 2009. Rent growth has slowed down dramatically. Even negative month over month. We're seeing reports of redemptions from all these non-traded public REITs, investors getting very nervous. Also, stories of some major portfolios, going into default. Interest rates have risen. They have low occupancy or low demand. Are we seeing the beginning of an actual potential market crash? Seeing some of those cracks, or is this we're witnessing a period of transition after an incredible amount of volatility, and we're trying to get into a new economy, and there's just going to be some eggs that are broken to make this new omelet of economy that we're making, and it's not going to look pretty, but somebody's going to get hurt as that water kind of recedes, and see who's swimming naked.
Yeah, I love that analogy on the cracking of eggs and making an omelet. I think what's happened is, you've seen over the past 2, 3, 4 years, it's been pretty easy to look like a genius because the rising tide of demand has really just made everything pretty much a surefire bet. Now, you're starting to see things slow down and you're starting to see some of the cream rising to the top. But conversely, you're starting to see where maybe some of those cracks are emerging. And I like that you led off there with the absorption or the demand angle, because for some of our viewers that maybe haven't been keeping up with the data, 2022 was the first time we've recorded negative net absorption in the apartment industry since 2009. And anytime you're comparing a real estate trend to 2008, 2009, not exactly the best starting point. But what's really interesting, and I'm sure we'll get into some of this through our discussion, but what's really interesting is when you start peeling back some of the layers that makes the 7-layer demand cake, if you will, I think you'll see that there's actually some stronger underlying fundamentals and not some of those big structural cracks that you had in 08, 09 that really made that a challenging period. So I think, to summarize there, I think what you're going to see is that some markets, submarkets, portfolios, whatever the scope of analysis you're looking at, you're going to see some additional bifurcation over the next 12 to 24 months that wasn't the case in 2020, 2021, where, outside of some very obvious examples where 2020 really threw a wrench in the works, you had most markets on this fast, rapid growth trajectory. And to your point, even through the 2010s before that, it was really hard to find a market or a submarket that was really struggling in the grand scheme of things. I think now you're going to see, maybe some of those higher leveraged portfolios, maybe some of those higher risk portfolios start to separate from the pack a little bit. But again, conversely, you're going to see some of that cream rise to the top.
Yeah. And it's been interesting, just from a broad brushing, the Sun Belt has been, such a strong performer, and the migration story in the Sun Belt is very, very strong and not going away anytime soon. But something that I've heard you talk about recently is kind of that bifurcation in the Sun Belt, in amongst other markets, of taking markets, like a Phoenix or Las Vegas. That Phoenix has just been just on a tear the last couple of years with incredible amount of rent growth. I mean, the cap rates that some deals are trading for in Phoenix in 2021 were absolutely. They were bonkers. I mean, great for the developers and the sellers, but now we've seen that boom, and now we're seeing a bust in some markets. But then there's other markets like in South Florida, or in maybe in Austin, that are still performing pretty well, or a Dallas that are still performing pretty well and seem to be much more stable. Do you see that trend continuing, and seeing which markets just have the legs under them and which have maybe just grown a little bit too quickly, too fast?
Yeah, that's it'll be interesting. I wish I had the real crystal ball
Yeah.
to see what that looks like. It'll be interesting to revisit this conversation, say 3 years from now, and compare our notes. But I think what you're seeing, and actually, funny enough, we're putting together an analysis right now. Hopefully, we'll be ready to share it in the next month or so. But basically, looking at 20-year market volatility, and you look at the likes of a Vegas and a Phoenix, some of those markets that were first out of the gate over the past year or so, or past 2 or 3 years rather, a lot of those markets are now some of the markets that are moderating the most quickly, really fitting that boom bust profile. And I think you're seeing a lot of these markets, that's just kind of the way they tend to behave. You get really big growth periods in the growth period, but when things start to get kind of tough, the sledding starts to get tougher, those markets really start to struggle. And for those types of metros, I've always, for any baseball fans on today's discussion, I've always used the analogy of those are kind of your number 4, number 5 lineup hitters that may hit 40 home runs in a year, but they may bat 200 because they're striking out a lot too. And I think you're
Yep.
seeing exactly that. Now, on the other side, you have a lot of these markets that fit that middle tranche. And I think that's where the Sun Belt story comes into play. You look at the Dallases, the Atlantas, the Raleigh Durhams, Nashvilles of the world. While they do have a lot of construction today, and maybe that informs maybe a little bit more of an unknown 12 to 24 month lookout, those markets tend to kind of move around the mean of the nation at large, and a lot less so than the fast growth in those desert Southwest markets. And to a lesser degree, some of the Florida markets, which here as of late have still remarkably kept a lot of momentum, which is, candidly speaking, been a little bit surprising to me how well they've held up relative to the desert Southwest. But nevertheless, I think what you're seeing is that volatility that was present 10 years ago. In some ways, that's still true today. And that's what's been interesting in this post 2020 period is you could take some axioms that held true through the previous 2 cycles and apply them today, and they still fit perfectly. You could take some other axioms, apply them today, and say, holy cow, why did we ever think that? But that's just how the nature of real estate, it moves and evolves, and what makes a lot of our type of work interesting, that we get to research these trends and what informs some of that change over time.
Yeah, it's fascinating to kind of study just the evolution of markets and cities, and just to see, yes, just see that maturity, or relative immaturity. In Phoenix specifically, it's a market we're not invested in, but it's such an interesting market that we've followed very closely. And we were wondering if Phoenix had kind of crossed that threshold of maybe maturing out of its boom and bust nature and just being a little bit more stable, kind of acting more like a Charlotte or a Dallas, just because of the amount of population growth that's going into that Phoenix market. But it still seems like they're not there just yet. So,
Right. Yeah. Sometimes zebras don't change their stripes.
yeah,
Phoenix is in better shape today than it was 10, 15 years ago because, as you point out, stronger population growth, more economic diversification. I think
yeah.
that's the real key. So I don't think Phoenix is as nearly worse a shape as it was
Mhm.
15 years ago. But again, whenever you had rent growth of 30% at one point in 2021, I think expectedly you expect that rubber band that if it gets pulled far enough forward, when it lets go, it's going to sting.
Yeah, and I think that's what I think is so important to keep in mind, for investors or people who are just watching the market, is that economics and I almost think physics at some time actually do exist, and these like laws of nature or economics, whether it's soft science or not, actually are starting to come into play, and that you do revert to the mean at some point. Now the mean can change, but to see 20, 30, 40% rent growth in some markets and not to see any type of correction, I think would be relatively improbable. So this really seems as though that something like this, some slowdown, is inevitable, and probably healthy over the long term, because things in general just cannot keep growing up in a straight line parabolically forever.
Yeah, I
So
love that. I love the comment on healthy too, because I think I think that's also what we're seeing with construction today. A lot of investors and operators, rightfully so, are kind of bookmarking today's construction as, hey, this is concerning. And I think in some very, very localized areas, neighborhoods and street corners, that is true. You look at a downtown Nashville, which that area has more construction today than a units exist. You've got literally 100% inventory growth.
that's
Near
incredible.
term, obviously that's concerning, but over the long haul, the nation at large needs this type of housing. And I think today we're starting to build housing specifically of the multifamily variety that was never built to the way it should
Yeah,
have been from 1990 to 2010, just kind of using ballpark
yeah.
estimates here. So we're really kind of backfilling what should have been built 20, 30 years ago. And now it may not happen today, but now that's going to start fixing some of or at least alleviating, I should say, some of the longer term affordability and availability crises that we see. Today's A becomes tomorrow's Class B housing.
Yep.
And I think we'll see that start to play out over a long period, but you got to start somewhere.
Yeah, no, it's interesting. I think we're starting to see that in some markets where at least the class A of a couple of years ago is starting to become the class B, those kind of mid 2000s, even 2010 construction properties that, up until a couple of years ago, you'd consider an A class, but they're really kind of solid B, especially to the type of product that's being delivered today. In terms of the pipeline that's coming online, that's being built, we had a incredibly robust pipeline for 22. We missed a lot of those deliveries. The pipeline was much larger than ended up getting built. We still have a robust pipeline, or it seems like, for 2023. I guess first, which are some of those markets that have an incredible amount of inventory relative to the existing stock that are coming online, that you are a little bit concerned of? Because a market like Dallas, which I think has like over 25,000 units under construction, Dallas is probably going to be okay. But what are some of those markets that you're a little bit more concerned about?
Yeah, some of those near-term concern markets are going to be reflecting. I hate to focus too much on the Sun Belt because I know we have folks that operate outside of those smile states, but you look at that, I call them rising star Sun Belt markets. It's
Hmm.
not DFW or Atlanta, it's Austin, Charlotte, Raleigh,
Hmm.
Durham, Nashville, kind of that next rung of big but not huge markets. The type of markets that have one or two professional sports teams as opposed to
Yeah.
four professional sports teams. That's kind of that rung that we're talking about. But Raleigh, Durham, Charlotte, Nashville, Austin, those markets have anywhere, in some cases, I should say, anywhere from 12 to 15% of all existing inventory under construction. And at a market level, this is a discussion we have with clients a lot. It's really hard to overbuild a market in mass. That takes a
Hmm.
long time to do, at least for a big market. You can overbuild small markets, but I think what will happen is that you're going to see some specific submarkets go
Hmm.
through some challenges. And here, as of late, that's really showing up as true in a lot of urban cores. Downtown Austin has something like 25% of its existing inventory underway. It's actually just east of the highway, which isn't technically downtown Austin, but just in that natural corridor of growth is, 20, 30% inventory underway. Charlotte, there's neighborhoods that fit that same profile, 20, 30% inventory. But again, it's not just the Sun Belt. Downtown Philly, a market you don't typically think is having a lot of construction, has
Yeah.
something like 16,000 units that are currently being built, which again should be built or should have been built probably over the past decade or two. So all this to say, I think if you have some markets that maybe are maybe not raising the red flag, but the yellow flag for now, I would look at that rising star Sunbelt profile. One market I'll throw in that's maybe kind of an unknown, just entering some untested waters, is Newark, New Jersey.
Mm.
And what you're really seeing is that because it is in many ways a satellite market of Manhattan
Yeah.
now, you're really entering this paradigm of growth where $3,000-$4,000 a month apartments are delivering in Newark, which was never the case, but they're actually capturing a lot of demand from Manhattan, as
Yeah.
renters would be paying $5,000 a month to live in Manhattan. So I think especially with a hybrid work model, you're able to capture some of that demand. So it'll be really interesting to see how some of these markets shape out over the next 5 to 10 years.
Yeah, it will be. And so what I'm hearing from you, Carl, is that, correct me if I'm wrong, but you're cautious, but you're not overly concerned about the kind of the pipeline going forward. But as is always with real estate, it's hyper local and it's really submarket specific. I mean, you could be. I mean, we're based out of Indianapolis. The downtown CBD has been struggling really since COVID. It's recovered, but it hasn't really come back. Barely positive rent growth, but in the suburbs, it's 20, 30% rent growth, and just going like gangbusters, and things are doing really well, but it couldn't be a different two different stories. So I'm curious, we've talked about the kind of the concern over oversupply, but the real crisis in housing is we don't have enough housing
Right.
units. And looking at the pipeline, maybe not for next year, but it looks like we may have a drop off in deliveries, after 2024 in 2025. Um, are you and the team looking at that kind of couple years out and how that will affect the market? And are we still not going to be building enough to get to the 5 to 6 million units that we need over 2030 or so? Or are we going to be? Are we still not going to build enough over the next decade?
Yeah, it'll be really interesting to see how 2023 and 2024, especially with some economic unknowns. Do we enter a
Yeah.
recession? Do we not enter a recession? Some of those things are obviously going to influence the 2025 and onwards pipeline. And for folks that maybe aren't as familiar, the number you're quoting there is probably that NMHC number that said that we needed something like 330,000 additional apartment
Yeah.
units per year delivered between now and I think it was 2030 or
Yeah.
2035, something like
Yeah.
that.
I think you're right.
And
2035.
the good news is even if we do see a slowdown post 2025, we'll probably, or at least in our view, we'll probably revert back to the 2010s norm, which was
Hmm.
about 320, 350, somewhere in there, thousand units delivering on an annual basis. But I do think that we'll certainly come down, certainly in the near term, from the current level of units delivering. We're forecasting just a touch under 600,000 apartment units delivering in 2023.
Wow.
Now, that doesn't take into account delays either. And we all know that delays are becoming more commonplace. So I
Yeah.
think in reality, what's going to happen is call it 20% of what's supposed to deliver this year pushes into 2024. If that's the case, then that means 2024 has about 600,000 units that are going to deliver. That may push deliveries into 2025. So you may see a
Yeah.
little bit of a snowball effect, but
Yep.
the question is just, are developers able to maintain a pipeline that's in line with 350,000 units in the event of a big economic pullback? We're not forecasting that. We think that if a recession were to materialize this year, which isn't in our base case, by the way, but if it were to happen, that means that obviously financing is going to be a little bit more difficult. Pro formas are going to be a little bit harder to hit. So
Yeah.
that would cause a contraction in the pipeline. We're not forecasting that, but it
Hmm.
certainly is something that we're watching.
Well, first, I think it's interesting that you're all not forecasting a recession because you talk to some, especially folks, a couple of weeks ago or before the end of 2022, a recession was almost certain and imminent. And while I think everyone acknowledged we're going through a time of economic, we're not really sure what to call it. It's not great, but it's not, looking at unemployment, it's not horrible. But whether we're going to use the R word or not has been a little bit of a hot button topic. But I guess so in my mind, we've got all these developers that are out there. Many of them are pencils down right now, not pushing projects forward just because of the uncertain economic environment, mostly due to rate uncertainty. They have no idea what the interest rate exposure may be over that construction period. There's also an uncertainty of price discovery and rent growth. We're still in the midst of figuring out what is the price for an asset in a given market. I mean, that debate, that bid sell, that bid ask gap is still pretty wide right now. However, I can see if things start to normalize and stabilize, become less volatile, maybe those plans will get dusted off and those projects will go forward. But if we entered a time of an actual recession, have an economic downturn, the chances of them going forward do not, I guess, increase. And then we could have a real supply shortage that could be unfortunate. That sound accurate or on the right
Yeah, I
track?
think that's probably I think that's a reasonable assumption. I think the real, I don't want to say unknown, but something that'll be interesting to watch over the next year or two is, again, if we do have a recession, is it a lowercase r recession or a
Yeah.
capital R
Yeah.
recession? I think that'll be the big that'll be the big telltale sign. And I think for now, our expectation is that job growth essentially flattens out over the next year. We're already seeing the tech sector is having some pretty significant pullbacks, but for now, it appears just pretty much agnostic to the tech sector. Doesn't
Yeah.
mean that it couldn't grow beyond that, but those are some things that we're watching. But yeah, that bid ask spread has been interesting to hear come up more and more over the
Yeah.
past 12 or so months, and I think it's going to be a big talking point for at least the next 12 months.
Yeah. I think so too. One thing that may make that gap not be as wide is a little bit more certainty on interest rates. Do you all have as your base case, a couple, additional 25 basis point increases, from the Federal Reserve on the Fed funds rate, and then mostly staying flat for a longer period of time? Or how are you all looking at the next couple rounds of Fed meetings and interest rate increases?
Yeah, so it's funny with the interest rate numbers because our team doesn't directly forecast that,
Yeah.
but we have to have an inherent kind of qualitative, if you will, forecast
Mhm.
on interest rates. And I think there's, as
Which
with
is the
any
right
good
approach,
economist,
by the way. I think that's because no one, because we don't know.
yeah,
Yeah.
exactly.
Yeah.
It's funny. You and I probably are in the boat where we have to explain that to a lot of people, but it's like you said, it's at the end of the day, you don't know. It's just a forecast. It's just a
Yeah.
best guess. Um, I think with interest rates, as with any economist, there's really two arguments that can be made. One is that historically speaking, the Fed tends to overshoot in controlling inflation, and I think to some degree we certainly did see that. I think the pace at which interest rates rose through 2022 was playing catch up from what should have happened the preceding
Mhm.
3, 4, 5 years, and we saw what that did to single family demand. I think in turn that also affected multifamily demand through proxy of affecting customer sentiment. You mentioned earlier unemployment rate. Go back to the Great Recession. I want to say unemployment was 10, 11% at its
Yeah.
worst, which is significant, certainly not downplaying it, but ultimately 10, 11% unemployment affects 1 in 10 households, just going based on that number. Inflation affects 1 in 1 households.
Mhm.
Nobody spared the impact of inflation. And I think we can all agree that 8%, 9% inflation was probably a very conservative estimate at the end of the day. So I think the Fed was obviously trying to control that inflation rate. They may have overshot in the near term playing catch up. So from that perspective, I think one could say maybe we are at the end of interest rate hikes, maybe another 25 basis points. But the most interesting counterpoint I read to that a couple of days ago said that the worst thing the Fed can do right now is recreate what happened in the 70s and 80s when
Mhm.
inflation got out of control, interest rates rose. As inflation started to cool, interest rates came down, but then inflation reared its head with twice
Yeah.
as much, Matt. And I think that's what the Fed has to be really careful with, and why we may not see interest rates come down, because the worst thing they can do is be wrong for a second time. And if interest rates come down and inflation really starts to spike a year from now, that would be just your absolute worst case
Yeah.
scenario, would probably cause stagflation, which is any economist's nightmare, or any economy, I should say, their nightmare. So, I don't know that I have a strong view on it either way. I just kind of wanted to present both of those arguments where I could see the end of hikes, but I could also see where there's room to capture another 100 basis points of hikes.
Yeah.
Maybe that's a little bit aggressive, but
Well, it's all kind of game theory to an extent with the
yeah.
Fed. I mean, they can move interest rates, and they can quantitatively ease or tighten. But so much of what it seems like they've been doing is really trying to affect the psychology of investors and consumers. Because to me, and because your work, you and Jay Parsons' work of talking about the consumer sentiment has really been the lead driver of this reduced absorption and just the lower traffic of folks walking into the door of apartment communities to lease. And I'm sitting here thinking, I'm like, you know, the Jerome Powell has this ability to affect someone's decision whether they're going to go lease an apartment by not adjusting interest rates, but just the talk about keeping interest rates higher and that putting the entire economy on edge, and just the psychology. So we're really managing everyone's psychology, and if there is a lot of pent up demand, giving everyone the green light with no more interest rate increases could potentially lead to higher rates of inflation. And then when the Fed's lost credibility, and we could be in a really bad spot. And for everyone, you said 1 to 1, everyone's going to be continually affected by the harms of inflation, and that's not a good recipe for anybody. Um,
Yep,
so
totally agree. Yeah, it turns out that $10 eggs and record and car payments, all that has a real impact on how people decide whether they're going to go buy a house or rent a new apartment.
yeah,
People tend to just do nothing, which means they renew their lease, or in this case, they don't move from their house. They just kind of tend to stay the course until things start to
yeah.
cool off.
Yeah, I think it makes sense. It's like, let's just stay put, and especially when you look at maybe a new apartment and the new market rent being significantly more than your renewal, then it's like, let's just stay put, even though they think the renewal may be quite a bit is relatively expensive everywhere. Prices have gone up. So on that note, these inflationary pressures, it seems to have affected, lower income, renters and, individuals who are just feeling the inflationary pressures, much more than those maybe living in, A-class luxury apartments. So we haven't seen, rent growth, and really, rent growth in C-class properties has been, negative relative to inflation. They have not outpaced inflation. A-class properties and upper end of Class B has been really doing pretty well. That's where there's a lot of growth that's been coming with all the new supply of A-class properties coming online the next, in 2023 and beyond. Do you see an inversion in some of the wages get caught up on the Class C renters, or I guess, do you have a kind of an idea, crystal ball for, the just different break income demographics at multifamily properties?
Yeah, I think that's a fair point to bring up, and I think this goes back to that point earlier of where you're going to start to see some bifurcation by, in this case, asset class, where certain Class A properties that are stabilized are going to be competing with 3 lease ups within walking
Yeah.
distance. So you're going to see, in some cases, some deeper concessions. I just happen to have this number at the top of my head, so I'll share it. Downtown Los Angeles, something like 10-15% of available apartments today are offering a concession, which isn't huge, but when they are offering a concession, they're averaging 3 months free. So that's a significant
Wow.
discount.
Yeah. Yeah.
When you start seeing that, that starts to, if there's consumer sentiment, there's also operator sentiment, and that can start to affect the psyche of nearby operators. So
Yeah.
I think what you'll see is some Class A properties that are stabilized today, or some Class A markets, if you will probably withstand pressure a little bit more than some others. I think you'll see a split within Class A. Class B is really interesting because you zoom out 30,000-foot view and look at apartments holistically. Most of the nation's apartment stock could be considered Class B. Just talking nice round numbers, we like to consider the middle 60-ish% of market rate properties based on their average rent. The middle 60-ish would classify as Class B assets. The remaining on the 2 tail ends, if you think of a bell curve, it wouldn't be the very ends, but just think of the bell curve and the 2 closer to the 2 tails, that would be your A and your C. So I think Class B is really in a good spot. I think you're going to see a lot of stability. I think Class B also is insulated from some of the inflationary pressures more so than Class C, which I'll talk about here in a second. But conversely, or in addition to that, rather, Class B is, a 25-30% rent premium versus Class A, meaning that your Class A rents are running 25%, 30% higher than your average Class B. So from that perspective, the Class A isn't going to be able to offer a deep enough discount to pull somebody from the B pool into that A pool of renters. Now, the Class B pool can take somebody from the A renter subset who's looking to save money, move out of the expensive area, whatever the case may be. All right, so last point, Class C. That's where things get really interesting. Class C is, as you point out, the inflation headwinds have affected that subset of properties far more significantly. We see collection rates in terms of percent rent billed versus what was collected. That's closer to 92-ish% in that subset of housing. If you look at the nation overall, it's closer to 95.5, 96%. That's a pretty big spread there when you start talking about the total existing stock of units. So Class C is going to be really challenged in the near term. Are they able to offset some of the inflationary pressure? You mentioned it earlier that real rent growth is probably coming in below that of inflation. And a lot of that too just says that Class C, historically speaking, rent growth tend to match the pace of wage growth as well. There wasn't a lot of discretionary income there. I think that component of the nation's housing market is where we really need to find some ways to support additional housing to service that subset of population, to allow for more supply to enter in that B to C pool, through whether it's subsidies, whether it's programs, whatever the case may be, to offer more housing for that subset of properties or that subset of renters. And that's where it gets really challenging, because that's where policy meets real world economic application. So I've probably gone on this point a little bit too long, but I think the takeaway would be that Class B is probably in a resilient spot for the next 2 to 3 years. Class A, you're going to have some areas that do well, some areas that maybe have some challenges due to construction headwinds. Class C, that's where we need to focus a lot more of our policy efforts and a lot more of our efforts to help offset some of the external economic pressures that is happening in that subset of housing.
That leads to a good point, and we didn't really talk much about this before the show, but I'm just curious. Politics can be seen as kind of the savior to the housing industry because we have this huge need for affordable housing that just the private sector is just not providing. At the same time, the government intervention can really mess up private investment in the creation of new housing stock, which we desperately need. Curious if you have any, I guess, worry cards or any predictions or things that you all at RealPage are tracking on the kind of the political front. Obviously, there's been some talk recently at the national level, and then there's all things moving around on the local level where so many of the zoning laws and where it actually rubber meets the road matter. Curious your take and how politics may affect the multifamily landscape going forward.
Yeah, it has a very real influence, and I personally don't live as much in the political analysis meets
Yeah,
economic analysis. It's something that I'd love to spend more time on. I just happen to most of my work
yep,
focuses on the economic angle. You bring up a good point though, and I think kind of the crux of what makes it so challenging is that there are national mandates, I guess, for lack of a better word. There's national policy, but it's really that hyper local policy where it starts to get really fragmented and really difficult to wrap your arms around. I'm going to call out Southern California, for instance. A lot of our analysis looks at market level, and I'll point out Orange County. Orange County, I think we have 12 different submarkets. Each one of those submarkets has multiple cities, and each one of those cities has a different rent control measure, different
yeah.
zoning laws, and that's where it gets so difficult to get your arms around. So, I guess if I had to give a concise answer there, it would be that policy has a very real impact on the real estate outlook, but it's just so hyper local that it's hard to summarize.
Yeah, yeah. No, I agree. The local zoning rules, rent control policies, regulations. It can be vastly different. City by city. Just in the same state, the same county. I know some markets in Indiana, Bloomington, I think, as an example, it's got Indiana University. So the Bloomington itself is a very, I'd say, left leaning government because it's college campus and that's what everybody likes. And it's a great town. But then you cross the line, it's completely different rules. And where we've got a property there, we can't, if a tree falls down, we can't move. If the tree falls down in the middle of the driveway, we cannot move the tree. The city has to come by and make sure that the tree fell the right way, and it's pretty insane. But that's in Indiana, which is a very deep red state. So it's fascinating. Carl, I'd like to go dig into a little bit more on RealPage and kind of the data and the pieces that you're putting out. So I'm curious. You guys track a lot of different metrics and KPIs. I think rent growth is probably the most talked about, the most reported. Which a lot of it's market rent growth, which doesn't necessarily tell the full picture. Um, I guess first, what are some of the metrics that you like to follow? Is it rent growth, or what are some of those KPIs that you see a study come out, or those are the first ones that you're looking at, seeing where they moved?
Yeah, so rent growth is an interesting one because a lot of people use that as kind of the gold standard, and I think in many ways it is. You go back a few steps and look at economics 101, rent growth is going to capture what's happening with occupancy and really demand in the moment. But in some way, I shouldn't say in the moment, because in some ways, rent growth is a lagging indicator as rents adjust to what's happening to the market.
Hmm.
We hear a lot about this idea, can demand be stimulated by offering concessions? I don't know that that's necessarily a sound approach to the numbers, because you're not necessarily stimulating demand.
Yeah.
You're really just kind of offering discounts in the moment. So while rent growth is powerful, I think there's other indicators you can look at that are maybe more real time, more telling. I think occupancy is kind of that number that a lot of people like to focus on. That is a time tested method or time tested metric, but I like looking at things like lead volumes. What's happening with today's front door traffic,
Yeah.
renewal conversions, how many residents are renewing their lease, is that changing over time? I think those are two really powerful metrics that kind of tell you where demand is going to head 30, 60, 90 days out. That's about as real time as you're going to get, at least in the data set that we work with.
Yeah, looking at some of those more leading indicators rather than lagging. And then, and I noticed, I think Jay Parsons put out a post on LinkedIn today about some kind of early numbers on some of that foot traffic, and seeming that the foot traffic and leasing activity may be picking up, early this year. I don't think we've got enough data to really make any good conclusions, but yeah, trying to look at what's going to happen in the future rather than what happened this last quarter is really important. So there's a lot of different publishers of this type of information, and something that Matt and I find that is interesting when we're looking at this stuff every week is there can be some pretty big discrepancies between different sources. The biggest example obviously is like when you look at rents as a part of CPI, and the way CPI tracks rents. It's completely different. It's been positive month over month, when we're seeing every other private metric go down or go negative. What should people keep in mind when they're looking at different sources, to make sure that they're comparing apples to apples rather than apples and oranges?
Yeah, apples to apples is kind of that trick where you want to make sure that you're comparing. You probably heard the term, or people on the call probably will hear the term same store before, but
Yeah,
that's an important thing that we like to note, because same storing can really make a difference on some of the numbers depending on what you're looking at. And actually, for what it's worth, I think it's good to calibrate based on two or three different inputs. You may have
mhm,
one that you tend to skew towards or lean towards, but that's some advice that was given to me a long time ago, is don't always take one thing as gospel. You can really lean towards something, but try to hear both sides of the equation. Really try to listen to more than
yeah,
one voice and one input. And I think that's important. So I think it's good that there's competition out there, and it also makes companies better at what they do by nature of that competition. It allows, or at least staves off complacency. But anyway, I'll get off my soapbox there. Um,
yeah. No, that's great. Though we've seen that as we like seeing different sources and comparing the two, and what that methodology is. And sometimes things make sense, and sometimes frankly, can be some other groups, not the Real Page team, but like, you guys just getting lazy over there putting this out, not thinking anyone's going to be reading the whole thing, or what. Now, the last question, and this is a little inside baseball, because again, it's something that Matt and I talk about. But we always talk about where you're getting your sources from, and what the motivations might be. And so I want take this the right way, because we love the work that you all do. But sometimes we say, okay, we look at a source from a not necessarily real page, but when we look at a source from a company that's also in the business, especially the brokerage firms, where I'm like, okay, you're also, 'cause, RealPage in the process of selling software and selling analytics and different types of software tools. Some of the brokerages, they're in the business of advising their clients on real estate, but they're selling real estate. And do you feel like there's ever any conflicts from the sources trying to be empirical, putting out good data? Obviously, if you're putting out trash, no one's going to listen to you. But do you ever think there's any pressures from some of the maybe other sources or anywhere in the market where maybe you're putting a little bit too rosy of lenses on just to not get your buyers to put their pencils down?
Yeah, I'm sure that it's out there. I'm sure that it happens. Something that is, I think, unique to the space that we play in is that we have clients that really service all forms of multifamily housing. So, we don't tend to skew we don't tend to skew too heavily towards one perspective or one
Yeah,
persona, if you will, than the other. Because to your point, the brokers may have a very different view than the developers, who have a very different view than the capital shops who are providing all the capital
yeah,
today. So, but one thing I will say that we do, and something that I'm really grateful for, is that because we service so many different personas, we're able to calibrate some of our worldview to say, oh, a group comes and talk to us, present some data, and it's like, hey, maybe, yeah, you have boots on the ground in that market. We, really can learn a lot from the stuff that you're seeing. As much as I love to think that we know everything about the nation. It's 50 major markets that we track, 100 smaller markets, and even more than that. And there's just no way that you're going to ever know everything about a market. And if somebody comes to you and says, "Hey, we're active in Bloomington, Indiana," then of course we're going to yield to what you're seeing in that market. And that feedback really helps us calibrate. So I don't know that we have too much of a challenge with that. I think we're probably in some ways blessed that we have so many of these relationships. That way, we're really able to calibrate and kind of fix or, gauge different market perspectives rather than just relying too heavily on that one source of input.
Yeah, yeah, that makes sense. But certainly whether it's where everybody's living or working, it certainly can start to influence on possibly coverage. And we complain sometimes, just again, just from our own our bias, that we're always like, where's the coverage for the Midwest, because it's so focused on the Sun Belt or the gateway markets. I mean, that's where the concentration of capital. That's where a lot of exciting stories and narratives are. Occasionally, I feel like the Midwest gets glossed over a little bit. But sometimes we like that because we're like, all right, that's fine. If Indianapolis is, number one rent growth market in the nation, if you're not paying attention, that's okay. We'll take it. But we're always just interested in kind of taking that next layer back and just seeing, okay, where, maybe what are some of the motivations, and just trying to understand we're getting the full story behind some of this information. But you guys do a great job, and we really appreciate it. All right, just before we go, I wanted just to highlight kind of just two last pieces, Carl, that you put out recently on RealPage. And again, I highly recommend for anyone that is a multifamily investor, you're in the industry, you're just curious, follow Carl on LinkedIn, because he's putting out some really good stuff. But also he's writing some really interesting pieces. And I know you mentioned one that's going to be coming up that you're going to be releasing in the next month or two, that we're really excited to see. I'm also excited to see you're going to be at NMHC coming up next week. Is
Mhm.
that right? You're going to be speaking at I think the Strategies and Outlook conference. I saw you in the agenda. That's really exciting. But so there's three types of markets that could struggle in 2023. And we talked about some of these factors a little bit earlier. This came out just a couple weeks ago. Carl, can you quickly kind of just give us a kind of high level overview on what three markets that we might want to look out for?
Yeah, absolutely. So that first one that you see there, big inventory growth markets, that goes back to our talking point earlier, where you're going to have some markets that they got a lot of supply to work through. I've used the analogy before of a snake eating an egg. It's eating all that egg at one time. It is not able to piecemeal it out. So I think you're going to have some markets that adjust here in the near term to that amount of supply pressure. The second market profile that we've flagged there is markets where loss to lease has really started to deteriorate quickly. And for those that maybe aren't as active on the operational side of the equation, loss to lease is essentially the difference between a new lease rent or a new residence rent versus what in-place residents are paying. And actually, you alluded to it earlier there, Spencer, when you said that a resident goes and shops for a new apartment. They see what that new sticker price is, and they're like, hey, this renewal actually is a lot more palatable from that perspective. So markets that are getting close to where renewals are actually more than new leases, you are running the risk of a gain to lease scenario, which means that your rent roll becomes inverted. And it's pretty rare. We don't see this happening very often, but there are a few markets that are running a little bit closer to that risk happening. I think we pointed out a few there, but it's in
Yeah.
places like Cincinnati, Houston, Jacksonville, more of the exception than the norm. But those are some markets to watch for. And then the third one, I think, is going to be really, really fascinating to see how it plays out over the
Yeah.
next few years. Lifestyle markets, that's a term I had never heard before the past 3 years. And what a lifestyle market is essentially an area that happens to be located nearby some sort of natural amenity, a beachfront market, a mountain town, some of those things. It's not your Dallases or your Houstons of the world, but a lifestyle market. I think the 2020 period saw a lot of demand flood into those lifestyle markets because of the work from home ability. Places like, and I'm not saying this is one that we're concerned about, but just for the sake of example, Charleston, South Carolina, it's an attractive location, probably pulled a lot of that East Coast demand in from New York, Massachusetts, et cetera. Some of that demand was probably always going to happen at some point in the future. We really just saw that it accelerated and crunched into that 2020, 2021 period. The question going forward, if we hit some more economic hiccups, how much of that demand stays in that market versus how much of it floods back to its original home market? It's obviously not going to be all one way or the other, but there is going to be a spectrum there where that demand falls. Is it going to stay
Yeah.
local or is it not going to stay local? And I think the local markets that have some sort of existing demand anchor, whether it be a college or a big employer or some sort of up and coming tech hub, something along those lines, those are going to be the markets with some staying power. The
Yeah.
markets that are really going to be challenged are those that aren't much more than just kind of a retirement market that are also
Cool
getting
place.
hammered with new supply.
Yeah, cool place to live. That, yeah, I guess one that comes to mind would be like an Asheville, North Carolina, maybe, which
Yeah.
is like I love Asheville, but the amount of apartments that are being built there, and the amount of people who've moved there, and how much of that is in the kind of the COVID pandemic period of where we were working from home, you kind of work from anywhere, and like let's just move somewhere cool. And but what's that staying power? What are the industries that are going to sustain other than we've got some awesome mountains and good hiking, fun things to do, and a lot of good beer. So
Yep.
yeah,
Yeah, exactly. Exactly. Great, great, great place. I love, love, love Asheville. But, to your point, if that's your investment thesis is, hey, it's got a lot of cool craft breweries, then is that really kind of the staying power that you want
yeah,
versus a Greenville, Spartanburg in South Carolina that has, big manufacturing facilities,
yeah.
it's got an established downtown. Maybe that's where you would want your capital flowing more so than Asheville. And again, my personal favorite would be Asheville because I
Yeah.
love that market, but
Well, we
that's
can
such a
see
good
why people are
example.
why we can see why people move there and would want to live. I mean, I have friends that live in Nashville too, and there's a lot of great markets like that. But yeah, when
Yep.
you're building your investment thesis, what are the legs that it's standing on? And if there's not some real jobs behind it, you kind of have to scratch your head a little bit. Carl, we're kind of running out of time. We've taken too much of your time, but this has been like such a privilege and a pleasure to have you on. I hope that you'll be able to find some time. We'd like to do this again sometime in the future, catch back up, kind of see where things are, because your insights are invaluable. And again, we're watching what you guys are doing, and we think it's great. So really appreciate it from Matt, myself, all the great report listeners, and everybody with Great Capital. Yeah, really, again, thank you for what you guys do.
Yeah. Thank y'all. Appreciate it. And we'll connect soon.
Absolutely, sounds great.